Folks, it is no secret that over the weekend we saw a banking crisis with Silicon Valley Bank, Signature Bank. We saw the powers that be come in with what can only be called a bailout of depositors. We now have at least implicitly guaranteed deposits across our banking system, not the FDIC 250K. We'll see if that holds. But at the end of the day, we are in the business here of investing in real estate, making a better financial future. And Omar runs an amazing operation in the high desert. So I wanted to check in and see what he was doing this weekend and what he thinks might come next. Omar, how you doing?
Good. What's up, Michael? What's up, everybody?
So for Omar, the first thing I want to ask is, I guess I'll ask it this way. Had you ever heard before Thursday or Friday, had you ever heard of Silicon Valley Bank?
No.
Had you ever heard of Signature Bank?
No.
Yeah, so this is the really important thing is I had heard of Silicon Valley Bank. Their headquarters is like 4 blocks from me. I live in the Valley, so it makes sense. I had never heard of Signature Bank. So it is kind of odd to me that 2 banks that most people never heard of last week go down as the second and third largest banking failure ever. One was over $220 billion. The other is 110, I believe. Those numbers report differently across different sites. But anyways, they were the second and third largest banking failures, and most people never heard of them. So Omar, as we're going through the weekend, I'm just curious, as somebody who runs a business, a small business, who is an investor, you have young children, were you kind of trying to stay up to date with all this banking crisis, or didn't hit your radar at all?
No, I wanted to stay up to date on this because I see something totally different that could potentially happen. I mean, because everybody decided to pull out their money, you know, their startups, and they're all small businesses, right?
Yeah, exactly.
And especially in Silicon Valley, it's a lot of tech companies that pull out millions of dollars. And I don't know the exact number that was pulled out.
42 billion.
$42 billion was removed. And I think I posted something about this yesterday in one day, right? And so how can the bank even sustain that? Obviously, we know why they can't now, right? Because it's just, they just can't. That's one bank. That's one bank. Granted, you know, I saw a graph of the bigger institutions, Wells Fargo, Chase, ginormous amount of, you know, of money that they hold or that they have compared to Signature and Silicon Valley Bank. But still, it's still a bank. You know, you bring in your money as a startup or whatever the case, and they can't repay you. So guess who's coming into the rescue? Other banks are. Other banks are giving, along with that deposit insurance fund, right? That has $100 billion in it. But my whole thing is like, if 40-some billion dollars was removed, 42 billion, and they have $100 billion in a nest egg, right, for that deposit insurance fund, what happens when that starts reducing, okay? And then the other banks are bailing out other banks, and then we're going to have some type of other crisis. But the part that we're not seeing is that where is this money going to come from? Because they're not just going to all of a sudden, you know, give the $42 billion to these banks. They're not. They can't. Because if that happens, what happens? They're going to start printing more money. Inflation's going to go through the roof. And guess what? Immediately, before they even called it yesterday, that they're not going to move rates. I was even saying, I guarantee you rates go down because they have to jumpstart this shit again. All the people that are on the fence about buying, they're not buying. So guess what that means? There's no interest being paid to banks to lend money. So if that doesn't happen, where are we at? We're at like, we're going to stall. We're like a fucking plane that stalls in the air and we're just gliding down. We're not gliding up. We're gliding down. So my opinion on this is because I was, you know, I went down the rabbit hole and I'm like, okay, what does this mean for us as normal consumers?
Okay.
Well, guess what? Okay, so one more thing. The way I see it, obviously, which I just explained, is I feel that if we don't get ahead of this and educate other people on what's going to be happening, we're going to be like, oh yeah, they printed more money, it's cool. And then there's going to be some influx into the government. What just happened with all of the PPC, PPL, all this other stuff, right? Or that bailout money.
Yeah.
We're going to go through this process again. And then what's going to happen? I mean, I want your take, Michael, because you've been around this longer than me. I'm just some fucking Mexican guy.
So I love that you went down the rabbit hole. I think a lot of people did. Again, I want to go through the timeline, right? A week ago, nobody knows these people.
Right.
You hear about stuff Thursday, Friday. Twitter goes nuts with all of these Silicon Valley venture capitals screaming fire, fire, fire. People like you go down the rabbit hole. You learn that the FDIC kitty is about 200 billion or whatever it is. People start going, oh my God, where's all the money coming from? It gets very scary very quickly.
Right.
And for me, so there's a whole bunch of education we could do there, but where I'm going with this is what happens next. Okay, Omar goes down this. He's a small business owner. He's an investor. He does this thing. He hears a scary thing. He goes down the rabbit hole. What happens? My opinion, as somebody who is an economist but studies human behavior, most people get scared.
For sure they do.
Scared is the easy emotion. Fight or flight. People get scared. I believe a lot more people are scared Monday than they were last Monday. Okay, what does scared mean? Well, scared means in this context, two things, in my opinion. One, if you are at a small bank, even if you have only 10 grand, you probably go to your small bank and you move it to a big bank. Many people are doing that or have done that or are thinking about doing it. Is it logical?
Or put it in your safe.
Or put it in a safe or mattress, buy crypto, buy gold, something. Scared, buy gold. Scared, buy crypto. Scared, put it in your home safe. Scared, go to a big bank. Human behavior. Second, you delay purchases.
Yep.
I think this banking failure or banking failure may cause a recession to start almost immediately. When a consumer is scared, they conserve, they delay. So this event, which will probably go down in the history books as a blip, is going to be the thing that causes a recession Q2, Q3, Q4. Because a scared consumer doesn't spend. That's what I think transpired.
Okay. So scared consumers they stay put, right?
They don't do anything. They don't, nothing expensive.
They're unsure.
No car. Yeah.
They're unsure.
Okay. And we've been told no more stimmy checks, right? So they don't have a bailout coming to them. Yes.
Correct. But do you think there is going to be a stimmy check?
No.
I like the way you say that. A stimmy.
Stimmy. Yeah, no.
So, okay. So now looking at this, I see one thing. I see, okay, there's a lot of people that probably won't know what's really going on and they're scared they're not going to do anything. I see things a little differently. Like, okay, well, guess what? If they're going to start printing, because they will, and what ends up happening? Inflation goes up. They're not going to increase the interest rate. What happened immediately after? It went down half a basis point, right?
Yeah, 50 basis points. 50
basis points, I should say, 0.5%. But
correct.
That's immediate. When's the last time we saw a 0.5% drop?
Black Monday, 1987. I looked it up.
Dude, I'm telling you. Okay. And that's just right now.
Yeah.
As this thing settles, we see another 0.5%.
Yeah. So let's talk about that, because one thing that a lot of people don't realize is what you and I are talking about right here is the 10-year treasury, I believe. Right?
Correct. Yes.
And you and I work in a real estate industry that uses the 30-year mortgage. Most people. 30-year mortgages peaked out, I think, just the other week at 7.08. As of yesterday, I think they are 6.57. They are down 50 basis points.
Right.
The Fed hasn't cut rates, but the consumer is scared. They run to safety: gold, bonds, crypto, all that stuff. So it's really interesting. So again, I go back to what I said: scared consumer, recession. So now let's play the Fed. I believe the Fed still raises rates a quarter point next week. I believe
you think so?
Oh, no doubt. Again, I'm happy to be wrong. I believe Powell wants to go one more step farther than everybody expects, because he doesn't want to stop short.
Okay.
I think he goes too far into a recession, which means, to your point, which is where you're going, he may have to cut faster and harder.
Got it. Okay. So he's going to go one step forward or increase, right? And then feels out what's happening in the economy. And then he's like, okay, you know what? I need to slash to 1% or 100 basis points.
Yeah, whatever. Yeah, that's where I think we're going. I think Powell will hike into a recession, hike into a scared recession or a scared consumer. But again, why is this important for you and me? Mortgage rates, I believe, are lower April 15th than they are March 14th. And that is after the Fed raises a quarter point. Because everybody thinks there's a one-to-one relationship. They're not related.
No,
they're not influenced. They're connected. But really, the long term is more about inflation. I think inflation is rolled over, coming down. You add on top of that consumer scared. You can go from what was reported today, 6%, to 3.5% or 4% pretty quickly. And then the Fed looks at that plus a recession, goes, oh my God, we're at stall speed. This economy is in trouble. And then you get the dreaded pivot and things get wacky. All of this into a real estate environment with no inventory. See video 1. Your inventory is down 50% about in 4 months, down 15% in 30 days. If we go sub 6, which I think may happen within the next 6 weeks, right into the spring selling season, oh my goodness.
Oh my, it's going to create some type of like, I don't know what it's going to create, because no one saw it coming in 2020, 2021. We can see it coming now because of what just happened. Like, we already have the results of what just happened. If it was sub 5, sub 6, and then we hit the 4, 3.5%. I mean, no one knew, but we were just in it. And now we know kind of what the result will be with all these people that are just sitting on the sideline waiting.
Yeah. The first-time home buyer, the VA buyer, they were basically frozen out for 2 years. We have the millennials aging into that perfect home buying years. If we get rates down, which increases affordability, into an environment with no inventory.
So now let's talk about the investor side of this.
Sure.
With no inventory, this is where good deals become great deals become awesome deals become grand slams.
Yeah, it really could. I think the one of the things, if you just talk about investors, the first thing I want to say is I think the traditional investor loans are going to get harder and more expensive. I think what you're going to see is first-time home buyer homes get cheaper, less fees, and they're going to add the fees to investors. I think Fannie and Freddie have clearly said home ownership good, investor bad. Simply say.
What that means, 100%. I went to go. Oh, sorry. Go ahead.
No, go ahead.
No. What that means? What?
So basically, what that means is more and more investors need to create relationships with non-QM lenders. I have a non-QM lender now. I had a student just. They worked with Convoy. They got a rate better than conventional loans with Fannie and Freddie. Not much better, but still better. So it's been a long time since non-QM could beat conventional. So I think investors should go and network with non-QM lenders. But secondly is if you happen to be a cash buyer or have private investors, you are going to have a leg up on everybody. Because I think the winner in this is somebody who could stroke a check for a dump, fix it up over 90 days until the FHA rule is gone, and then sell to first-time home buyers. That's where I would be playing. I still would not touch luxury.
No, unless you're stealing it.
Yeah, stealing. Yeah, or want to live there.
True. Yeah, that also.
Yeah. So yeah, I think it's wild times, man. It's crazy.
crazy times. And yeah, it's interesting because we're going to see this unfold the next 3 to 6 weeks. And we're going to be talking about it every Tuesday.
There you go. Every
until
Tuesday.
Something happens.
Yeah. Folks, you can go back and watch Omar's playlist. We have several years of content. You can watch when it was easy to make money. You can watch when there was a pivot. You can watch us take a couple of L's. And you can watch how we are changing our business and going forward. Omar, if somebody wanted to join your amazing team or just follow all the things that you're doing, how would they do that?
Guys, go to my IG, Invest with Omar, or go to my YouTube at Omar Alfaro.
Thank you, buddy. I appreciate you.